We're back today with an options video. We're going to do this on screen. By the end of this video, we're going to bring all this together. You're going to know exactly how to price and purchase a long call or a long put using the tools that we discussed in a previous video. If you're not familiar with that, there's a link in the description below, which will give you access to that video, and you'll be able to learn exactly what we do in order to price and select the best option contract for the long leg of any strategy. So remember, we're talking about either long calls, long puts, or the long leg of any strategy, whether it be a spread or debit or credit spread. My name is Frank Bunn. I've been teaching traders how to get consistent trading stocks, options, and just about everything else since Buddha was a baby. We're going to jump right in by using free tools on the internet, access to sites that anybody can have. It won't cost you a nickel, and you'll be able to do this and get a definitive edge over everyone else out there, because most people do not select the proper contract for the long leg of their strategy. I'm going to show you exactly how to do this. We're going to go to barchart.com right up here. Really, really simple. Click stocks. There will be some ads here. You can ignore them. You can also create an account, which you don't need. This is just a real easy way in like 5 minutes to select the best contract. So what we want to do is from stocks, what we want to do is we want to first get a quote. So we're just going to start with, we'll start with Tesla, TSLA. From here, we just go down to option prices. Click options prices there. And what you'll see is you'll see Tesla. Now, this is an options montage or an option chain of calls and puts for TSLA. So the first thing we want to remember that there's three things that we talked about: volatility, time. Those are two primary things, and also the underlying asset. So in order to select that, the proper contract, we're going to start first by looking at the option chain itself. So remember what we talked about, that historical volatility, which relates to the underlying asset, in this case, the shares of Tesla stock itself, or implied volatility, which is over here, which has everything to do with the volatility of the option chain. Now, remember that when historic volatility is greater than implied volatility, or that is to say, when implied volatility is less than historical volatility, the option chain itself is said to be inexpensive. When you flip that, it's said to be expensive. So right now for April, it looks like they're right about, evenly priced there. So it's not really more expensive. It's not particularly less. Okay, so that's the first thing that we want to look at when we do this. Now, remember that in order to select the best long leg of any strategy, we want to begin by considering that to be a leap. So we need to avoid the wasting asset cycle. So what we're going to do is we're assuming that we have a low risk entry in Tesla here. And what we're going to do is we want to go out. We're going to go out because we're looking at monthly options. We'll do weeklies in another video, but the monthly option, we're going to go out to June. It's May, it's April, early April right now. So we're going to go 2.5, almost 3 months out, which will help us eliminate the wasting asset cycle. So we could look at July. In this instance, we're going to look at June. So remember, we want to be greater than 60 days in order to get around the wasting asset cycle. Okay, so what we do is we bring this up. Now, the first thing we want to check is implied volatility versus historical volatility. Implied volatility is less. So it looks like right now, at this particular point in time, the June calls on Tesla are slightly less expensive. The next thing we want to do is our current price is $11.45. So we're going to need an in the money, slightly in the money. Remember, we're not buying these cheap. We're not trying to save a buck. We want the option to take off as the price does. So we don't want volatility burn. If you don't understand what volatility and delta burn are, link the video in the description below. Okay, so we're going to take a look here. Currently at 1145, we're probably going to go out to, let's say, 1125. You can see here that gives us, we're going to look at the Greeks here in a second. So their volatility in the Greeks. So we have the current, the expiration is June, and we're going to look at 1125, which gives us a delta of 5797.5797. We want to be in the 60s, though, in the early to mid 60s for the best contract here. So we're going to go back to this 1100 at 0.612. Now that takes care of the delta. Now also notice that the implied volatility here is just about close to the lowest in the chain. The lowest in the chain is 58. This is 60. And we also want to notice the theta. Okay, so the theta is 0.8. So let's just run a quick comparison because we talked about time. So let's go back and look at the near money. We'll look at the near money Aprils. Skip that. We're going to go back to monthly April. Okay, so what we can see here is we want to look at the theta. Notice that the near money theta for this month is $2. All right, this is how people get burned trading options. Okay, notice what we've done is we found a contract that has about a third or a quarter of that theta by shopping this correctly. It's extremely important. Okay, back to June. So we're back to June and we're talking about the 1100. Okay, so the 1100 call is it's fairly valued. The delta is 6125 and the theta is just 80 cents. Compare that to the $2 theta that is on the near month call. Okay. So we're going to use that later then to, again, remember, we always want to buy the cheap option and sell the expensive one. So that gives us a theta of 0.8 with the proper delta in a historical volatility chain that is about fairly valued. It's really as simple as that. Now, this 1100 contract, given my low risk entry in Tesla, I stand the best shot of having that take off immediately, and that price will move, that premium will move in tandem with the price of Tesla because I've selected it properly. Okay, so that means that as I hit the parabola, as Tesla accelerates, so will my delta move into the 70 and 80 percentile on the way to parity. Extremely important. When you're at the 40 and 50 area of the delta, you get what's called delta burn, and that Tesla will take off, but the delta will lag until you hit that 60 to 70 area, where again, then you'll move commensurate with the stock on up to through the 80 percentile. Okay, so that's really that simple. We want low theta, a delta of 60 to 70, and we want to avoid the wasting asset cycle. Very simple. So what we're going to do then is we're going to go over to our retail brokerage, and we're going to enter Tesla. So we're going to see Tesla here. So we want to go out to June, and we have chosen the June 1100 right there. Okay. So we don't have a strategy. So we have the June 1100. There's the buy. So we're going to look at buying to open the June 17th 1100 strike call. Okay. So always work a limit and good for the day. That's exactly how we're going to do this. Now notice that all of the tools that you need in order to successfully select the best contract for the long leg of any position are missing. The tools are missing from most retail brokerage accounts. That's an issue. You have to understand how to price these, and you can get consistent first learning how to trade and then selecting the best option for that low risk entry. And this becomes a game of consistency. If you are having trouble getting consistent, finding low risk entries, you're really going to want to do that first. You might be interested in my free training. There's a link to that as well in the description of this video. This explains exactly how to select the best long option, whether it be a call or a put, for any strategy that you're using. We're going to use this in tandem as we search and experiment and explore other strategies moving forward. Thank you very much. Have a great day, and we'll see you next time.